A massive move is underway in silver and gold right now, and if you think this is just another rally, you're missing the real story. Silver just crossed $100, gold is knocking on 5,000, but here's what almost nobody is talking about. Major institutions are quietly stepping away from what was once considered the safest asset on Earth. Pension funds overseas are reducing their Treasury holdings, and when the world starts questioning the default safe haven, the repricing doesn't just happen in metals. It happens across every strategic material the global economy depends on. This isn't a trade. This is a structural shift, and the next move could catch even the prepared off guard. Welcome to boring currency analysis. If you've spent decades building wealth, protecting assets, and making serious financial decisions, then you already know that the most important insights rarely come with fireworks. They come with facts, data, and uncomfortable truths. This channel exists for one reason: to deliver the analysis that matters without the noise. If that resonates with you, consider subscribing. Not because we're asking for a favor, but because in markets like these, missing one critical piece of information can cost more than years of careful planning. And before we begin, leave a comment and let us know, where in the world are you watching this from right now? Because what's happening in metals isn't just an American story, it's a global repricing, and your perspective matters. When silver moves past $100 an ounce and gold climbs within reach of 5,000, most people see it as a victory. They celebrate the numbers. They watch their portfolios turn green. But seasoned investors know better. They know that when prices arrive early, when targets hit before anyone expected them, it means something has been building beneath the surface for longer than the market realized. This is not just about higher prices. This is about pressure, accumulation, and a fundamental shift in how global capital views safety itself. Right now, 3 completely different groups of investors are moving into metals at the same time. The first group consists of long-term hedgers, the institutions and family offices that protect wealth across generations. They are not chasing momentum. They are repositioning for what comes next. The second group is industrial buyers, the manufacturers and producers who need silver for electronics, copper for infrastructure, and strategic materials to keep supply chains running. They are securing supply, not speculating on charts. The third group is momentum traders, the ones who see breakouts and want to capture short-term gains. They bring volume, they bring volatility, and they bring risk. When all 3 groups enter the same market simultaneously, the result is rarely calm. And right now, we are watching that convergence happen in real time. But here is what most people are missing entirely. This move in metals did not happen in isolation. It happened while something much larger was unfolding quietly in the background. For decades, the default assumption across global finance was simple. If you want safety, if you want reliability, you buy long-dated government bonds, specifically United States Treasury bonds. That assumption is now being questioned. Not loudly, not dramatically, but persistently. Major pension funds in overseas markets have begun reducing their exposure to long-duration Treasury holdings. These are not small players. These are institutions managing hundreds of billions in assets. Institutions that move slowly, carefully, and with serious consideration. When they start lightening positions, it is not a panic, it is a recalibration. One large emerging market country is now holding the fewest United States Treasuries it has held in years. Another major pension group hinted publicly that it is reassessing its allocation to American debt instruments. Other large funds in those regions have made similar statements about reviewing their U.S. asset exposure more broadly. Does this mean they are abandoning American markets entirely? No. But it does mean something critical. The era of blindly assuming that long-dated government debt is the automatic safe haven, the unquestioned foundation of every portfolio, is ending. And when that assumption breaks, when investors and institutions start asking the question out loud, the market immediately begins searching for alternatives. That is where gold appears. That is where silver appears. And that is where copper, uranium, lithium, and other strategic materials begin attracting serious capital. Because these assets do not depend on promises. They do not depend on policy. They depend on scarcity, utility, and physical reality. Gold serves as a trust gauge, a measure of confidence in the existing monetary system. Silver functions as both a trust gauge and an industrial accelerator because, unlike gold, silver gets consumed in manufacturing, in electronics, in infrastructure, in grid expansion. Copper does not care about politics. Copper cares about building, wiring, electrification, and power distribution. When investors lose faith in paper promises, they move toward hard assets. And when that movement begins, it does not reverse easily. Now here's the part that should concern every serious investor. This repricing is not happening uniformly across the world. In certain parts of Asia, silver has been trading at prices well above $100. sometimes closer to the mid-120s, even mid-130s in local markets. That kind of price gap is not normal. It signals localized stress. It signals localized demand surges. It signals supply constraints that are not being reflected in the futures market prices that most people watch. And it raises an uncomfortable question. If physical silver is trading at a significant premium in one region, while futures contracts show a different number, which price is real? The answer is both. But the gap between them tells you that the market is not moving smoothly. It tells you that availability is becoming more important than spot price. And it tells you that the next phase of this move could be far more volatile than anything we have seen so far. Because when price and availability disconnect, when buyers are willing to pay well above the listed price just to secure metal, it means the market is transitioning from speculation to desperation, from watching charts to securing supply. And that transition, once it begins, does not stop until supply catches up with demand, or until demand gets destroyed by price. Right now, we are still in the early phase, but the pressure is building, and the question every investor needs to answer is simple. Do you understand what is actually driving this move, or are you just watching numbers on a screen? Because the difference between those two perspectives will determine whether you survive what comes next or get blindsided by it. There's a narrative circulating right now that sounds simple, sounds logical, and is dangerously incomplete. It goes like this. The dollar is weakening, and when the dollar weakens, metals automatically rise. End of story. Except that is not how any of this actually works. And if you build your understanding on that oversimplification, you're setting yourself up to be shocked when the market does something you did not expect. Let me show you why this matters. Yes, a softer dollar can act as a tailwind for commodity prices, especially metals. But metals can also rise aggressively in a strong dollar environment. If real yields are falling, if trust in institutions is eroding, or if global uncertainty is accelerating faster than currency movements, gold is not a one-variable equation. Silver is definitely not a one-variable equation. And copper, uranium, lithium, none of these materials move simply because one currency index ticks up or down. They move because the world is changing beneath the surface. So let me give you the real framework, the one that actually explains what is happening right now. Governments everywhere are juggling three objectives simultaneously. They want economic growth, they want to control inflation, and they need to manage debt service costs. These three goals form a triangle, and that triangle is brutal. If you push too hard on growth, you ignite inflation. If you fight inflation too aggressively, you crush growth and tip the economy into recession. If you let debt service costs rise unchecked, you start hemorrhaging cash, just paying interest on existing obligations, and that bleeds into every other policy decision. So what do policymakers do when trapped inside this triangle? They try to thread the needle. They talk tough about discipline. Then they soften the language when markets react. They tighten policy. Then they hint at future easing to calm investors. They protect the system. And protecting the system almost always means one thing. Real purchasing power gets sacrificed over time. Not because leaders are incompetent, not because they do not understand economics, but because sacrificing purchasing power is the least politically painful option available. You can raise taxes, and voters punish you immediately. You can cut spending, and interest groups mobilize against you. But you can allow slow currency debasement, and most people do not notice until years later. That is why the debasement narrative keeps resurfacing. Not because it is a conspiracy theory, but because the incentives driving policy have not changed, and based on recently published data about deficit trajectories and interest cost burdens, those pressures are intensifying, not declining. Now layer geopolitics on top of that economic triangle. Trade routes are being disrupted more frequently. Export controls are appearing on materials that were freely traded just years ago. Energy agreements are being renegotiated as alliances shift. And every time one of these disruptions occurs, markets stop pricing a smooth, efficient, interconnected global system. They start pricing a fragmented, messy, unpredictable world. And fragmented worlds reward hard assets. Because hard assets do not depend on cooperation. They depend on scarcity and physical utility. Now let us talk specifically about silver, because silver is where this entire dynamic becomes visible. Silver crossing $100 is not just a price milestone, it is a psychological event. For years, investors have watched silver struggle beneath its previous historical peaks. They have seen it rally, then collapse back. They have heard promises about breakouts that never materialized. But when silver decisively breaks through a ceiling and holds above it, something shifts in the market's memory. The old peak stops functioning as an anchor. New buyers stop looking backward at where silver has been. They start asking forward-looking questions. What is the next level? How high can this go? And that shift in psychology alone can extend a move far longer than skeptics expect. But silver's story is not just about money flowing into a shiny metal. Silver's story is about industry. Every year, manufacturers consume silver in electronics, in electrical contacts, in soldering applications, in medical devices, in chemical catalysis, and increasingly in solar infrastructure and power grid expansion. When you build more data centers, you use more silver. When you electrify transportation networks, you use more silver. When you expand renewable energy capacity, you use more silver. And here is the critical detail that most people overlook. Unlike gold, which sits in vaults and changes hands without being destroyed, silver gets consumed in tiny, scattered amounts across thousands of industrial processes. Much of that silver is not economical to recover. It is embedded in circuit boards, in switches, in components that get discarded or recycled without extracting the metal. That means the supply story for silver is not as elastic as people assume. You cannot simply turn on a tap and flood the market with new supply when prices rise. Mines take years to develop. Recycling has limits, and industrial demand does not disappear just because the price went up. Now let me give you the counterpoint, because I want you to hear both sides clearly. There's a temptation to say that industrial demand guarantees higher prices. That is not always true. Industrial demand can slow during recessions. Manufacturing output can pause. Inventories can be liquidated. So industrial demand is a tailwind, but it is not a shield against price corrections. What makes silver truly explosive is the combination. Industrial demand pulling metal out of circulation, combined with investment demand from buyers seeking alternatives to depreciating paper currencies. When both forces align, silver can overshoot every analyst's model. When one weakens, silver can snap back violently. Right now, both forces are present. And that is why the next few months will matter more than most investors realize. Because we are not just watching a chart move higher. We are watching a repricing of trust, scarcity, and strategic necessity. And when those three forces converge, the outcome is rarely calm. There is a detail emerging from global markets right now that most people are not paying attention to. It is not appearing in headlines. It is not trending on financial media. But it is showing up in the data, in the premiums, and in the behavior of buyers who are willing to pay far more than the official spot price just to secure physical metal. In certain parts of Asia, silver is not trading at $100. It is trading at $120, $130, sometimes higher. That is not a typo. That is not a temporary glitch. That is a signal. When regional premiums disconnect that far from futures pricing, it tells you something critical about the underlying market structure. It tells you that physical availability is becoming more valuable than paper contracts. It tells you that buyers in those regions are not waiting for spot prices to come down. They are securing supply now, regardless of cost. And it tells you that the so-called efficient global market for silver is not nearly as efficient as the pricing models assume. Now, some people will immediately jump to the conclusion that one country is cornering the market, manipulating prices, or hoarding metal. That is too simplistic. Local premiums can emerge for multiple reasons. They can come from import taxes, shipping delays, currency conversion costs, or sudden surges in local demand. They can also come from temporary mismatches between what futures contracts say silver is worth and what people are actually willing to pay to hold physical metal in their hands. But regardless of the cause, the outcome is the same. The market is not moving uniformly, and when markets fragment, volatility follows. This brings us to a concept that separates informed investors from those who only watch price charts. The concept is called availability versus price. You can have a high price and still have a shortage. You can have a lower price and still experience tightness in supply. Price is a signal. Availability is reality. And right now, the signals coming from the physical market are telling us that reality is tighter than the futures market reflects. Wholesalers are quoting longer lead times. Certain product sizes are harder to source. Premiums are rising even as spot prices climb higher. These are not the characteristics of a speculative bubble. These are the characteristics of a market where genuine demand is outpacing comfortable supply. Now let us shift to copper, because copper is the material that nobody talks about until it is too late. Copper does not get the attention that gold and silver receive. It does not inspire the same emotional reactions. But copper is the foundation of everything the modern world is trying to build. Every year, the global economy consumes approximately 30 million tons of refined copper. Recycling covers only a portion of that demand. The rest must come from mining, refining, and processing new ore. And here is where the problem begins. It takes years to bring a new copper mine online. You have to explore, identify viable deposits, secure permits, build infrastructure, negotiate with local communities, arrange financing, and then finally begin extraction. Even in the best case scenario, the process takes 5 to 10 years. In contested regions, or in areas with weak infrastructure, it can take far longer. And the quality of newly discovered copper deposits has been declining. That means mining companies have to move more rock, process more material, and spend more capital to extract the same amount of copper. So when analysts say that copper supply is tight, they're not exaggerating. They are pointing at a real structural constraint that cannot be solved quickly. Now add demand to that equation. The world is not reducing its need for copper, it is accelerating. Electrification requires copper wiring. Data centers require copper for power distribution and cooling systems. Renewable energy infrastructure requires copper for grid connections. Electric vehicles require significantly more copper per unit than traditional internal combustion vehicles. And grid modernization projects, which are being planned or executed in dozens of countries, require massive amounts of copper just to upgrade aging transmission networks. Before you even factor in population growth, urbanization, or industrial expansion in developing economies, the gap between future copper demand and future copper supply is measurable, significant, and growing. And here is the part that should concern every business leader. Copper shortages do not stay confined to the copper market. They spread. When copper becomes expensive or scarce, everything that depends on copper becomes expensive. Power lines cost more. Transformers cost more. Motors cost more. Construction projects get delayed. Manufacturing timelines extend. And suddenly, a material that most people never think about becomes a bottleneck across the entire economy. But copper is just one example. The real story is concentration. A massive share of global refining and processing capacity for critical materials is concentrated in just one geographic region. You can mine ore in many places, but turning that ore into the high purity chemicals and refined metals that industry actually needs, that capability is bottlenecked. Take lithium. Most people think lithium dominance is about mining. It is not. It is about processing. One country controls approximately 2/3 of global lithium chemical processing capacity. That is not a perfect figure, and it shifts slightly year to year, but the core reality remains. The choke point is not extraction. The choke point is refinement. Take copper again. One major player imports an enormous share of global copper ore, refines a huge portion of the world's copper, and consumes a substantial percentage of that refined copper domestically. That means the same entity influences supply, demand, and pricing dynamics simultaneously. Now take a lesser-known material like molybdenum. Molybdenum does not trend on social media. It does not inspire documentaries, but it is essential. It strengthens steel. It enables high-temperature performance in industrial applications. It supports critical infrastructure, pipelines, refineries, turbines, heavy machinery, and defense systems. And one country accounts for a dominant share of global molybdenum production. When that country tightens export rules, shipments to Western markets do not slow down. They disappear. This is not theory. We have already seen exports of certain specialized powders and molybdenum-based alloys drop dramatically after new controls were introduced. So when you combine three factors, concentration, restrictions, and rising demand, you get a recipe for price shocks. And price shocks are what pull mainstream attention into the commodity complex. Because suddenly, materials that seemed boring, obscure, or irrelevant become front-page news. And by the time they reach the front page, the strategic positioning window is already closed. So the question becomes unavoidable. What do you actually do with all of this information? Because understanding the macro story is one thing. Positioning intelligently is something else entirely. And the gap between those two, between knowing and acting, is where most investors either build wealth or lose it. Let me give you a framework that cuts through the noise. Instead of chasing headlines, instead of reacting to every price spike, build your analysis around functions. Ask 5 questions about any material or asset you're considering. First, what does the world physically need more of? Second, what is long lead times that cannot be shortened easily? Third, what is difficult or impossible to substitute? Fourth, where are the processing bottlenecks, not just the mining bottlenecks? Fifth, what is politically sensitive or strategically important to national security? When you run those 5 questions consistently, you keep landing on the same cluster of materials: gold, silver, copper, uranium, lithium, and a handful of specialty alloy metals. These are not random picks. These are materials where supply constraints, demand growth, and geopolitical importance intersect. Now here's how to think about each one functionally. Gold is the trust gauge. It measures confidence in the existing monetary system, in central bank policies, in currency stability. When gold rises persistently, it is telling you that trust is eroding somewhere in the system. Silver is the trust gauge with an industrial accelerator attached. It benefits from the same monetary concerns that drive gold, but it also benefits from physical consumption in manufacturing, electronics, and infrastructure. That dual demand structure makes silver more volatile, but also gives it more upside potential when both drivers align. Copper is the electrification gauge. It does not care about monetary policy. It cares about building, wiring, power distribution, and whether the world is investing in infrastructure or pulling back. Uranium is the baseload planning gauge. It reflects whether countries are serious about reliable, low-emission power generation over the long term. Lithium is the storage and mobility gauge. It tracks the transition toward battery-based energy systems, grid storage, electric transportation, and decentralized power. And the specialty alloy metals, materials like molybdenum, are the infrastructure and defense gauge. They reflect whether nations are prioritizing industrial capacity, military readiness, and supply chain independence. When you organize your thinking this way, you stop chasing tips. You start watching systems. And systems are what matter when volatility arrives. Now let me address the risk side, because this is where most people get it wrong. The biggest mistake investors make in commodity markets is confusing a correct thesis with safe positioning. You can be absolutely right about the long-term direction and still lose money. You can understand the macro drivers perfectly and still get wiped out by a liquidity shock. Because here is what happens during real market stress. People do not sell what they want to sell. They sell what they can sell. They sell whatever is liquid, whatever has a bid, whatever can be converted to cash quickly. And that includes metals. That includes miners. That includes anything that traded smoothly yesterday but might gap down tomorrow. So if you are positioned in this space, you must respect volatility. You must respect the possibility of violent short-term reversals, even inside a long-term bull market. And you must respect your own psychology, because nothing destroys a sound thesis faster than panic selling at exactly the wrong moment. This is why I watch the bond market as closely as I watch metal charts. When bond volatility rises, when credit spreads widen, when liquidity conditions tighten, the stress bleeds into every other asset class, and commodities are not immune. Now let me give you two scenarios for what could happen next. Scenario 1. The move continues with pullbacks that get bought. Gold grinds higher as investors continue rotating out of long-duration paper assets and into real stores of value. Silver remains volatile but holds above key psychological levels like $100. The broader commodity complex keeps trending upward, confirming that this is not a single asset bubble but a structural repricing. In this scenario, the macro forces remain intact. Trust continues eroding. Supply chains remain stressed. And strategic materials continue attracting capital from institutions that are reassessing what safety actually means. Scenario 2. We get a sharp correction. Maybe it is triggered by a sudden spike in real yields. Maybe it is triggered by a geopolitical event that shifts risk sentiment overnight. Maybe it is triggered by a policy announcement that nobody anticipated. Or maybe it is simply a crowded trade getting cleaned out, the way crowded trades always do. In this scenario, the pullback will feel catastrophic in the moment. Headlines will declare the bull market dead. Analysts who were bullish last week will turn cautious, and retail investors will panic. But if the underlying macro forces remain, if the drivers have not changed, the market will stabilize, consolidate, and eventually push higher again. So the question is not which scenario happens. The question is what tells us which scenario we are entering. Watch real rates, watch the dollar trend, but do not treat it as the only variable that matters. Watch credit spreads, because credit stress shows up before equity stress. Watch commodity breadth, meaning how many materials are rising, not just one or two. And watch physical premiums across different regions. If premiums keep rising, even as prices climb, that is a sign the market is not speculating, it is securing supply. Now here is the wild card that could surprise everyone. It is not a mine shutdown, it is not an export restriction, it is not even a supply squeeze. It is the policy response. If metals keep running, if commodities keep climbing, and if inflation expectations start reawakening, policymakers will be forced into a decision. They can tighten policy harder, which risks breaking something in the economy, or they can stay accommodative, which allows currency debasement to continue. Either choice creates volatility. If they tighten aggressively, risk assets wobble, liquidity dries up, and metals can get hit in the short term. If they stay soft, real purchasing power continues eroding, and metals keep grinding higher over the long term. So the next shock might not come from the commodity markets at all. It might come from a press conference. It might come from a central bank meeting. It might come from the market suddenly realizing that the soft landing narrative was far more fragile than anyone wanted to admit. That is the cliffhanger you need to keep in your head, because markets do not move in straight lines. They move in waves. And the investors who survive, who build wealth across cycles, are the ones who respect both the opportunity and the risk. So here is the bottom line. This price action is both a warning and an opportunity. The warning is that volatility is coming. The opportunity is that when a structural repricing begins, It often runs longer and further than the crowd expects. Stay informed. Respect risk. Do not chase blindly. And keep your eyes on the macro signals, not just the daily price movements, because in the end, the investors who win are not the ones who predict every turn. They are the ones who position intelligently, manage risk carefully, and stay disciplined when everyone else is panicking.